Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. We again have a very fully packed show ready to go this week.
And you know what? We're going to talk about something fun, a little bit from my book, Matt.
Right.
We're going to talk about fads and how you can maybe capitalize on them. There are always some shoe fads, there are some clothing fads, and so we'll talk about some stocks that really made some big gains and why they made those big gains.
Right, and even if you're not a fashionista, you can certainly make money on these stocks, and we'll talk about how to do that. We're also going to do a new segment called Would You Sell This Stock? And the idea is to have it be a simulation so you can play along at home.
All right, but first let's take a look at the market. Well, the market definitely changed colors this week. We went from choppy to downright ugly. We sold off sharply on Thursday and Friday, and our market outlook is now in correction, so be cautious here. Although a bounce would not be surprising. We had a perfect storm of events that caused this massive sell-off. First, we've been talking about for some time that we've been in an aging bull market since March of 2009. Then we have the confluence of weak corporate earnings. We have global economic slowdown, especially in China, as well as a rattled Chinese stock market. We also have concerns over borrowing as the Fed prepares to raise interest rates, although we could make an argument here that low inflation and a higher dollar really doesn't warrant a raise in those interest rates.
Right, and this is why we talked about the monthly chart for the NASDAQ last week, just to put it into perspective, and it does seem to start to be rolling over at this point. So like you said, we've definitely seen a change from choppy to just downright ugly in the last couple of days. And here's what that looks like on the NASDAQ daily chart. It lost support at that first line of defense, the 50-day line on Tuesday. Then on Thursday, it crashed below the second line of defense, the 200-day line. And it was not alone. The S&P and the Dow also tanked. So there was very little refuge in this week's sell-off.
And you can say that again, Matt. The leaders, you remember last week on the show, we had talked about there were leaders that were really holding up.
That's right.
Well, this week that changed. We had the Facebook dropping below the 50-day. We had Netflix dropped below the 50, along with, and they were not alone, we had Nike, eBay, Starbucks, and Under Armour. Google also came under some selling pressure. So basically, to determine the market direction, we look at the indexes and leading stocks. And the fact that so many big growth names got hit this week just shows the seriousness of this correction. Now, we don't know how long it will last or how deep it will go, but for now, cash is king.
That's right. And to see what we're talking about, just look at the IBD 50 stocks. You'll find them in Monday's paper. Just scroll through that and you see what we're talking about. Many have sold off, and while there are some that are still trying to find support, maybe at the 10-week line, or they're just trying to hold on, you have to ask yourself, how long can that last if the NASDAQ and the S&P continue to head lower? At that point, it's tough for any stock to hold its ground and move higher, particularly for growth stocks. So cash is likely a better place right now for a lot of people than a hold and hope strategy.
Absolutely. And be careful about getting back in too quickly if we do bounce. People will say, oh, maybe we found a bottom. Let's
Game
go,
on,
let's go.
Right,
Some of these stocks are cheap. Let's get back into them. But the problem with that is you can get faked out by a short-lived bounce only to get whacked if the market corrects further. Now, what we're looking for here is a follow-through day. Okay, so that has to come on day 4 or later. And we want stocks to break out of nice bases or price consolidations on strong volume to indicate that it's a safer time to be back in the market.
And waiting for that indicator is key because, like you said, it's very easy to get fooled by daily ups and downs. You want to have some signals that give you more confidence to start easing back in.
And that's the beauty of CAN-SLIM investing. We have a solid system to follow, and that keeps our portfolios safer by following these rules, especially when the market is difficult.
The other thing is, don't get discouraged. This is part of the cycle. To have the big bull markets, you have to have
the
bear markets and the corrections. It's just part of the cycle. So first of all, make sure you protect yourself and you reduce your exposure. Then you want to sit back and watch the market to see if the current leaders end up forming new bases and look for that new crop of leaders. And they always emerge at the beginning of a major new uptrend.
A correction is actually exciting.
It's an opportunity, so wait for it to come around without getting suckered back in too early. Now, Amy, I don't know a lot about fashion, Surprising, I know. But everyone knows that fads and fashions can lead to big stock market winners. And people of a certain age will remember that back in the 80s, you had those leg warmers and the Reebok shoes.
Everywhere.
Everybody seemed to be wearing those. So today we want to take a look at how to spot and profit from these kind of fashion-driven trends.
All right, let's take a fun historical look at some fads. Here's Clark Gable in a scene from It Happened One Night. He took off his shirt, Matt, and there was no undershirt. It was shocking at the time, and it started a trend. And then we had a streetcar named Desire, and out came Marlon Brando, and he wore only a T-shirt, sending a sensational trend of white thin T-shirts, and T-shirt sales soared by that year's end. Then we move forward, and we have Ray-Ban sunglasses worn by none other than Tom Cruise
on
in
his
Top
motorcycle.
Gun. Yes, and this was another hot fad. And of course we had the Uggs boots, which hit the scene at the same time that my daughter was in junior high.
I remember that very well too, because I remember Christmas time and these Uggs were so popular.
Yes,
they
they
were actually
were.
really hard to get.
Yes.
And of course, she had asked from Santa, my daughter had asked Santa to get her
bring
a
her-
very specific color, right? I'm calling every store in the area trying to find this.
So they have to be blue. They have to be
Santa cannot
yeah.
disappoint, right? But the company behind that was Decker Outdoors, and that did have a very big run because of the massive popularity of those Ugg boots. So, of course, these new fads and companies, they come along all the time.
They
So
do.
it's important to know how to spot them and how to make money from them once you do. So, Amy, in your book, How to Make Money in Stocks Success Stories, some of the folks that you profiled in there had some interesting examples of getting into these fashion-driven stocks.
Yeah, in the chapter from my book called Breaking Boards, Successful Trades and Lessons Learned, there's a section that talks about fashion, trends, and fads. So when I interviewed Surfer Pat, as he is affectionately known from Manhattan Beach, he said when I interviewed him, he said that his first big winner was Skechers. Well, this was many, many, many years ago before the company reinvented themselves.
Right.
They were headquartered in his hometown of Manhattan Beach, and he saw moms and little kids at the beach, and he saw them wearing these Skechers shoes. So that was a big winner for him, but he first looked at a chart. He waited until the stock was in a price consolidation, and it broke out on big volume, and then it went on, and it had big gains for him, and it got him really excited about investing in the market.
Right, and like you said, we're talking about an earlier run for Skechers that happened many years ago. Now, of course, that initial run eventually came to an end, as they all do, but Skechers rejuvenated the brand, it entered new markets, and it created another big move over the last couple of years, although it has pulled back somewhat recently like the rest of the market.
Now, another person that I interviewed for my book was Keir McDonough. He's from Boston, and he discovered a shoe company called, remember Crocs?
Of course.
Back in the day, they were known as the Ugly Shoes. This is October 2006,
Right.
and it had an impressive 13 quarters in a row of triple-digit gains before it made that big move.
Yep.
And the earnings growth were up 330% and 120% in the the two most recent quarters when it made its move, and sales had vaulted 232% and 309%. Now, Keir also discovered that a highly rated fund manager had a big stake in Crocs, and that was up from the prior quarter, and this helped Keir add to his conviction in Crocs. So Keir bought it out of an IPO base and added to his position as the stock ran up. And he was sitting on a gain of 378% when Crocs reported earnings. October 31st, a year later, though, it crashed big time after reporting earnings, and it was down 31% for the week. Obviously, he locked in his profits and he got out of it when it slumped like that.
Now think too about what time this was. This was October 2007, just before
Before
we went into that bear market that was caused by the collapse of the housing market
Freddie and Fannie.
and the financial crisis. That's right. So it's a good reminder of how you don't just look at the hot product and the profits. You also have to take into account the general market conditions as well as the chart for that stock. And what you're going to find is most of these big winners surge when we're in a good market uptrend,
Uptrend.
and then they pull back either just before or around the beginning of the market slipping into a bear market. So always keep that in mind. Don't just get blinded by how hot and cool and this product
New
is.
product
and you're
is.
seeing it everywhere. You have to look a little bit deeper than just that.
So some other shoe fads that Keir has studied are Reebok, LA Gear, and Deckers Outdoor. This is, of course, they profit from the Uggs boots.
Yep.
But he studied these past winners to see how they behave. Now that we're in a correction, this is a very good thing to do. Take a look at some of the big winners from the past and study their chart patterns. Our chairman and founder, Bill O'Neill, has done this, and of course, he became a wonderful investor. By studying these past winners, it's going to help you handle big winners in the future better.
And another question you may have is, how do you find these kind of companies to begin with? Well, one thing is what the former Fidelity fund manager, Peter Lynch, always talks about. Basically, look around you. Where are people shopping? What are your kids buying? What are the most popular stores at the mall? Mm-hmm. Find out about that kind of thing. Now, another thing to do is check IBD. Look at the features, the articles, the stock screens, and that will also lead you to some of these potential big winners. And Crocs is a good example of that from 2006.
This is a very good example. Crocs was in the New America on October the 12th, 2006. And these articles are terrific places to learn more about companies that you might not know much about. And I remember hearing that a lot of doctors in the hospitals and a lot of hospital staff were wearing Crocs because they were so comfortable and they were easy to keep clean.
And when you hear or see something like that, you want to get curious and start digging a little bit deeper to find out who are the companies behind this. And another thing you want to do is to check the leading new issues section, which is near the New America article as well. And it shows you the top performing IPOs, and Crocs was on that list many times in the lead up to that October 2006 breakout.
Well, one thing is for certain, we will see fads again, and we will be able to profit from them in the future. So just make sure you are consulting a chart before you buy a stock, not just because it's a good story.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
For this week's Teachable Market Moment, we're going to talk about a simple concept for finding winning stocks. And the idea is to look for a company whose products or services solve a problem, and preferably that will be a big problem that a large number of people have. And back in 2013, BitAuto certainly fit that bill very nicely.
Well, BitAuto was riding China's largest growth in passenger car sales. Now, remember, we had the middle class that was expanding,
Right.
and more consumers were able to afford cars. So auto dealers in China were seeing these soaring sales. Now, BitAuto solved a problem for three different groups. We had the consumers,
Yep.
we had the car dealers, and then the auto manufacturers. So if you had those first-time buyers in China looking online, this was kind of like Yelp. You could see the reviews for different cars. And they were looking to buy cars, so BitAuto had a lot of consumers looking online. Now, you marry all three of these things together, plus we had soaring earnings, we had sales that were just off the charts,
Right.
and BitAuto made a big gain.
And that's the key point, that BitAuto had a service that fit this large changing demographic trend in China and the economic trends that were going on at that point. And it solved a problem for the customers and the clients. And look at August 2013, what its numbers were like. You mentioned those
Huge
earnings.
numbers.
131% annual EPS growth rate, which gave it a 98 EPS rating and the highest possible 99 composite rating. So that's what was in place before
it
BitAuto
made that
broke
big
out
run.
and made that big move.
Now, BitAuto came out of a fourth stage base. This is an unusual chart that we're going to take a look at. You know, usually later stage bases run into trouble, but in August 2013, it ran up 37% before forming another base. This was your fifth stage base,
Right.
okay? Remember, this is very unusual. And then it ran up another 43% before taking a breather. Now, take a look at these gains. These are pretty nice gains in here. Then it formed a sixth stage base and made a gain of 22%. And then, Matt, yes, it did. It formed a seventh stage base.
Well,
and
wait,
it
there's
made,
more.
There's more.
Yes.
And it made a move out of that base. It moved higher for 13 weeks before it finally formed that eighth stage base. Again, this is very, very unusual, but remember the big demand that was there for this company. That's why it ran so long. Now, quarterly earnings had soared from December 2013. They were up 58%, 100%, 96%, and 70%. And the sales were stellar also. Now, after that, you know, the party has to end sometime. January 16th, the stock cratered and lost 26% for the week.
That's right. Now, BitAuto is just one example of a stock that solves a problem and therefore becomes a big market winner. Just think about Apple back in the day where there were already many music players on the market, but they were hard to use.
Yeah.
They didn't store that much music. And then the iPod came out and solved that problem. Smartphones, same thing. There were a lot of smartphones, but they weren't that intuitive. They were hard to use. And then the iPhone came out and just broke it all open. Netflix, same thing. They made renting DVDs really easy, and they got rid of those late fees, which killed a lot of us.
Blockbuster.
That got really old to pay those. So it solved a problem, and it became very popular, and then it moved on to bring streaming, on-demand streaming, into our living room. Now, of course, all stocks eventually run out of steam, and they take at least a temporary breather. But in a strong market uptrend, you want to look for stocks that solve a big problem for a large number of people in an industry that has a lot of room to expand and grow. Those tend to become the top performing stocks.
Today we're going to have some fun with would you sell this stock? And we'll use a simulation so that it seems more real. And hopefully it's going to provide you with a little bit of learning here. We're going to take a look at Skyworks Solutions. Now, Skyworks' motto is connecting everything and everyone all the time, delivering analog information, enabling ubiquitous connectivity, and powering the Internet of Things with billions of connections, helping to change the way the world communicates. This company supplies chips for Apple used in their mobile phones.
But this segment is not about buying Skyworks. It's
about
about whether or not you would
sell
sell it at this particular point in time that we're going to discuss. And the idea is to do this as a simulation, as Amy said earlier. So we encourage you to play along at home. And let's start with a look at the daily chart.
All right, it formed a flat base and it broke out May 18th, but volume was only 27% above average. Now remember, you want to see 40% or higher, showing that the pros are in there with conviction. But sometimes it can take a day or two for volume to kick in.
But let's say you did buy into it and it did make some progress over the next couple of weeks. You would have been up around 5% by June, but then it did start to pull back. And by June 9th, it was below the buy point, but it did find support at the 50-day line.
So are you a seller here or are you holding? Now it fell below the pivot of 102.87, and volume on that trip down to the 50-day was on heavier volume. So what are you doing? You're thinking, are you holding, are you selling? Let's say that you held on. Well, the stock did move higher for about a week and a half, but as the stock was moving higher, the upside volume was mostly lower.
So at this point, maybe you're patting yourself on the back for holding onto that stock, but volume on that rebound was not convincing, and chip stocks in general were showing volatility at that time, and the NASDAQ and the S&P were still in that seesaw behavior stage. So you need to have a defensive plan in place at that point so that you have an exit plan in case the stock goes against you.
Now, the stock made another trip down to the 50-day line on June 29th. So this was the second trip to that line, and volume was above average. Along with this, the iPhone sales were down, so the demand for these chip stocks was waning. At this point, honestly, ask yourself, would you be a seller here or are you a holder?
Now, to help make that decision, another thing you want to do is to look at the general market conditions. And at that time, the outlook was uptrend under pressure. We had 8 distribution days on the S&P and 6 on the NASDAQ. So the stock was below the buy point. You were sitting on a small loss. The chip industry was hurting, and the market was under selling pressure. So this could certainly be a time to reduce your risk and avoid potentially larger losses. And here's another thing to consider. Skyworks had already at this point made a very big run.
All right, let's take a look at a weekly chart. Now, Skyworks had made a move from January 17, 2014 from around $30 and ran up to a peak June 19th of this year for a 273% gain. That is a heck of a run, and at some point stocks will pull back. Now, some stocks run farther, but you just need to be aware, have this in the back of your mind as you're looking at a stock. It's already made a pretty big move.
Right, so that was the situation you were facing at that time. And the odds at that point were not in your favor. So let's go back to the weekly chart and see what happened next.
Skyworks rolled over and lost the 10-week line and then lost the 40-week line. And it did so on massive volume, showing professional selling.
So even without 2020 hindsight, it was clear at the time that some defensive action was needed, and reducing your exposure in Skyworks was a smart move even before that big hammer came down and whacked the stock. So to learn more about selling, you can see when to sell stocks in IBD University on investors.com.
Be sure to come see me in Las Vegas in a couple of weeks. I will be teaching a level 1 workshop. These are now free, so be sure to come out and continue your education. Also, we have an exciting webinar next Wednesday. That's August the 26th at 4 p.m. Pacific. We have Executive Editor Chris Gessel, and we have Portfolio Manager for William O'Neill, Mike Webster, and they are going to talk about IPOs. Should be really, really good, so be sure to tune in.
That'll be a great webinar to check out, and you can find out all about how to watch that webinar as well as how to sign up for workshops, level 1 and other workshops. We also have more advanced workshops as well. You can find out all about that at investors.com/investingshow.
All right. See you next week, everybody.